Okay, on that note, let's welcome Devang Mehta, the Head of Equity Advisory at Centrum Wealth Management, to discuss the fundamentals of the market. Devang, afternoon, and thanks so much for joining in. Let me straight away get into the IT companies because that's where all the numbers are going to be expected. Today, post-market hours, you've got TCS. Tomorrow, you've got Infy. Now, both these stocks have been big outperformers, but in the last 3 months, they've come off close to about 10 to 20% from their lifetime highs. How would you approach the IT stocks, and what should we expect today?
Afternoon, Rima. I think clearly IT was the darling of the market in the last 1 year, and for reasons like demand growth as well as the companies coming up with good set of numbers, and also I think there were cross-currency tailwinds for the entire sector, which we saw in the last 1.5 year. I think with the advent of 2019, again, I think the currency sort of an advantage which these companies carried seem to be now at least on a vanishing spree. My sense is now the merit of the business would start taking more predominance. And having said that, I think TCS and Infosys with another name like HCL Tech, probably one of this has to be a part of the portfolio. Again, saying that IT you should be just over the board will be a wrong statement, but I think there is a definitive sign that some of the parts of this economies are improving. BFSI in certain cases have also shown decent traction. So the numbers I think would meet the street expectations, if not sort of exceed.
All right, Devang, we take that point then. I was just going through your note and you're saying that this year is going to throw up a whole host of opportunities, but the key factor is always going to be earnings. You have mentioned in terms of the corporate profits to GDP, how that ratio had gone down in 2017, but expecting it to improve going ahead. Just a basic question. What kind of a nifty EPS growth are you factoring in? The last few years, we have been hoping to get that 15, 20, 25% by the end of the year. We'll end up with a 10% growth. 2019-20, is that the year when we see that big 20% earnings growth finally come about?
I think clearly, yes, as you rightly said, there was a half a decade of sort of lost earnings. The last 5 years, we would have grown at 7 to 8% on a very conservative basis. Having said that, the next 2-3 years seem to be, everything will come back to the fore with financials, with NCLT in place, with a lot of recoveries happening on the corporate side. I think the earnings should come back. And earnings, again, at the start of the year, it's very frequently seen that people start off with a 20-25% type of earnings growth. Of course, I'm not in the camp that belong to that. So maybe if it comes around, say, mid-teens or late teens, the market would take a good heart from that. And probably in the next year or so, after the year, say, 2019-20, maybe in 2021, we start seeing that 20% or more than 20% type of growth. But yes, right now, to begin with, you shouldn't talk about in excess of 20% growth. 17-18% would sort of please the market and soothe the nerves of a lot of investors.
You are recommending corporate banks. So that is one of your recommended plays when you structure your portfolio. So in that, I want to get your views on 3 banks. One, IndusInd Bank, after the kind of numbers they've reported, the dip that we're seeing, would you recommend buying that? And secondly, ICICI Bank and Axis Bank have already put in a pretty good rally. ICICI Bank is trading close to its 52-week high. Is it still attractive at these levels if someone has to enter in fresh?
I think yes, IndusInd Bank has always been a sort of a favorite stock, and it's one of the portfolio stock that would be a disclaimer. ICICI and Axis Bank post the management changes, what we have seen was a very, I can say, underrated trade in the market, and the last 2-3 years have been very volatile for for both of these companies. I think with management change in place, with NCLT resolutions coming to the fore, with a lot of recoveries also expected to happen, I think there is some money which is surely moving towards this type of banks. So my sense is at this type of valuations, money would start moving in from the so-called, I can say, crowded trades to this type of trades, where I can say the 20, 25, 30% could also be made in the next 1 year, 1.5 year period. So I think they are good tactical bets at this point, and of course on a long-term fundamental basis also improving fundamentals and improving numbers would sort of support that trend.
That's taking the markets down a tad bit. So now the Nifty is down about 40 odd points, and the Sensex has lost close to about 100 points, and the Bank Nifty too, on account of Axis Bank, has slipped a tad bit. We still have, I think, Devang Mehta with us.
Yeah.
Okay. Devang, so if purely, would you recommend your investors to buy in the market right now, or would you wait for the election risk to be out of the way? When you have to construct your portfolio, would you recommend buying right now?
I think yes, we have been constructive in the markets when it fall big time in the month of say November and December. Also, we were advising our clients that this is a market which probably does not give you opportunities again and again. And if you wait for an election, if it goes the result goes against you, I think there can be buying panic sometimes, which you need to experience or which you get to experience rather. So my sense is, rather than timing the market, election results of course would would probably have a course correction at that time, but I think the market adjusts itself within a quarter of election results that we have seen over the period. So my sense is yes, invest in tranches, just construct a portfolio, pick great businesses, the combination of consumption, financials as well as capex, which has come back, and we have mentioned it in our note as well, that the capex seem to be right now coming back with good execution capabilities, with good numbers coming in, with good order flow. So I think yes, construction of portfolio very well should be done in the next 3-4 months before the election as well.
Well, Devang, you're joining us on an interesting day when the mid caps are doing a relative outperformance. In that context, how would you position yourself between the large caps and the mid caps? You know, to break up maybe 100 rupees, how do you do it percentage wise? Do you take exposure to the mid cap, small cap? Some of them have seen a big correction and they could have come to attractive levels. But in the last couple of months, we have seen some kind of buying on mid caps and small caps. So if we are deploying fresh money, how much do you put to large caps? How much to mid caps?
I think on a ballpark number, I would say at least it has to be a sort of a 70-30 between the larger caps, or I can say the largest of blue chips or the bluest of blue chips, and maybe certain mid caps. And of course, I wouldn't like to just paint it with the same brush, but mid caps also, I think the most important thing would be the quality consciousness or the corporate governance of the companies, as well as the business growth, or I can say the monopolistic or the oligopolistic advantage that business carries. So we have been more fond of, I can say, themes where there are robust businesses, of course, which are growing, and there is evidence of growth. Of course, we are not playing turnaround candidates as such. So yes, a ballpark figure would be roughly around say 70-30 to be a little more safe than sorry. But it again depends upon the individual client preferences or the risk-taking ability. But mid-caps surely have corrected, and a good bit of correction has been seen in the valuation. So mid-caps look attractive if you just buy the good businesses.
Okay, mid-caps look attractive. Thanks, Devang, for joining in. Get into a break. Up next, we'll get a whole host of buzzing stocks in a movers and shakers segment. Stay tuned for that.